Good day, everyone. Well, in yet another step towards a fully Orwellian society, PayPal recently announced they would remove as much as $2,500 from a user's account if that user was deemed by them to be spreading lies. Kind of might ask yourself, when did PayPal become the dictatorial judge without any courts or lawyers to arbitrate? This is the dawning of CBDCs, which are central bank digital currencies. And the aim of CBDCs is to control our money. In China, if one has a poor social score, a person could see their rate of interest drop. So, imagine seeing your bank account shrink in real time because your interest rate bearing account dropped below 0% because some score dropped below a certain number. And all of that is to say that crypto is important. Fundamentally, crypto has to do with freedom. Freedom is the use case. Crypto is the counterbalance to government control over our money. Bitcoin is the Magna Carta of code. There are no constitutional rights without the freedom to transact. CBDCs are an intentional effort to revoke this freedom under the guise of convenience. The Canadian government's response to the truckers' protests recently nicely illustrates this. Bitcoin's decentralized, so no government can control it. Just as we have separation of church and state, Bitcoin separates money and state. It is borderless, which has enabled millions to sell their plummeting local currency into Bitcoin than into dollars, especially those who live under deeply corrupt governments. Indeed, the number of hyperinflationary currencies in the developing world continues to grow. Fiat currencies derive their value from the full faith and backing of their respective government. As long as society has faith in their fiat system, their currency will continue to have value. It's backed by taxpayer dollars. Unlike fiat, Bitcoin derives its value from its scarcity combined with its utility, as well as its network effect. For example, if you have a single phone, it's pretty useless. You can't make any calls through it if no one's connected to your phone. But as soon as the number of phones grow and the network increases, the value increases exponentially. Analogously, Facebook can be easily duplicated, and it has been duplicated, but such Facebook with very few users or no users is worthless. Meanwhile, the real Facebook with its billions of users is one of the most valuable companies on the planet. So with Bitcoin, network adoption is the factor which plays the leading role in adding value to it. Its hash rate and number of users both recently reached all-time highs despite this year's bear market. The number of Bitcoin users tends to double every 12 months, so is projected to be used by about a quarter of the planet by the year 2026. Bitcoin has also value because it can't be corrupted, printed, or inflated away. So unlike fiat, Bitcoin has no central bank, and its decentralized structure provides security, utility, and the borderless transfer of value. And that's why the price of Bitcoin continues to rise to new highs against fiat reserve currencies every few years. In many ways, Bitcoin can also act as a store of value similar to gold, though it's far more volatile since Bitcoin is still climbing its S-curve. Nevertheless, its gains have been unparalleled, having risen by hundreds of millions of percentage points over the years. $1 worth of Bitcoin in 2010 is worth a few $1,000,000 today, even after losing more than 2/3 of its value. That said, gold was volatile in the 1970s, and we know it can be confiscated, stolen, or lost far more easily than Bitcoin. A friend of ours has 8 figures worth of gold buried in his farmland. With Bitcoin, you just need your seed phrase and internet access. Of course, if there's little to no internet nor electricity, the world is then probably looking at a far more dire situation. But in all likelihood, any internet outages will be resolved by mesh networks, and they're designed to override any government blockage of the internet. Nevertheless, the world sits at numerous tipping points. We've got record debt, soaring inflation, historically low interest rates, plunging markets, political upheavals, the possibility of nuclear war. And the counterbalance to all of this authoritarian world that is being born is blockchain, which is the beating heart of Web3, and that's the beating heart of the metaverse. So you can think of the blockchain as a view-only Excel sheet for the entire history of transactions. As the former chair of NASDAQ said, eventually all stocks will be tokenized. I would add that eventually every single piece of land around the world won't be written onto the blockchain. If it lets rather people easily track the history of owners, sell and trade the land, borrow against the land, and sell it fractionally, among many other things. And then you've got DeFi, which makes it possible to put every real world asset on chain, including your possessions, your art, your jewelry. If it will make legacy banking a dinosaur due to its far greater efficiencies at far lower costs. But in the meantime, economic data, as far as we see it, all point to recession. The Fed minutes that will be released today at 2 p.m. Eastern, they're likely to be as hawkish as the Fed has been as of late. I don't think there's going to be really any surprises there. The hawkish stance by a variety of Fed members last Friday remains firmly in place, given the strong unemployment report. We also have the CPI that's due tomorrow at 8:30 a.m. Eastern. The core CPI estimates are expected to come in at 6.3% year over year. That was the same number reported the prior month. Food, rent, healthcare, electricity, and natural gas have been soaring, and there's little indication that these items have materially fallen in price, as there are often lagging effects that take time to push prices lower despite the rate hikes. And we've also got the supply chain, supply side, which remains broken. So with less supply, greater inflation. And I guess we had this, we had the ISM manufacturing new orders index, and that just hit the line that characterized a number of prior recessions. And so even American Express said we're in a recession, so they downgraded their earnings forecast more than once for the next year. And the CME Fed futures, they've raised the odds of a fourth 75 basis point rate hike. I think last I looked was at 80%, and then followed by a 50 basis point rate hike in December. And that would bring the FFR to 425 to 450. So with market downtrends firmly in place and the dollar in its very strong uptrend, we expect lower markets and higher dollar against major foreign currencies until the Fed either reduces the magnitude of the hikes or gives indication, as they did back in December of 2018, that they would halt the rate hikes. And that did mark a major low for both stock and crypto markets back then. But this time, the bubble is far more massive and macro is far worse. So the unwinding of this massive bubble could be said to be at least as large as the dot-com bubble or even the Great Depression bubble that was formed. And in both cases, markets continued to plummet even after the Fed started to lower rates. So despite the Fed saying that we're still not in a recession, keep in mind that in the second quarter of 2021, the Fed did say inflation was transitory. Then in the third quarter, they said inflation is rising, but will likely peak soon. Then in the fourth quarter, they removed the word transitory. Then in the first quarter of 2022, they went full hawkish, saying they would have to hike rates aggressively to curb inflation, but not to worry because the economy remains strong, so a soft landing is possible. But then in the second quarter of this year, they admitted to negative growth in the first quarter, but no risk of recession. Then in the third quarter, they admitted that while the economy remains strong, despite now 2 quarters of a drop in GDP, which would normally define a recession, they said we're still not in a recession, though now admit that a recession could happen, but it'll probably be a gentle one. Well, with such a shockingly poor track record, along with a refusal to see reality, one wonders what additional gross misstatements the Fed will be making in the fourth quarter. Gil, how are you seeing everything?
The Fed sucks. That's how I'm seeing it.
Yeah, you said it.
Okay, let's think about a few things here. The first one being that, the market started raising rates long before the Fed figured out that that's what they needed to do. So my guess is when they finally do crash the economy, or we get to a point where they're going to crash the economy, the market will figure out that they're going to have to turn the other way before the Fed does. So that's something to watch for. But the bottom line is we're kind of in what I call the panic zone here, where we've continued lower. So you had the bear market rally topped in mid-August, and now here we are making lower lows. So you're in a position where theoretically you could have an undercut and rally type of move in the indexes, or we could just and then that might create a panic among shorts who then panic and run into cover. But that's what they were doing in here and also in here. Was that last week or a couple of weeks ago? About a week and a half ago. Okay, so here we are now breaking to lower lows. So the other side of the panic zone is that the longs, whatever longs are left, panic out of their positions, and you have a massive collapse to the downside. So if we look at a weekly chart of the SPY, we can see that you basically have, and I think I've shown you guys this before, you have one leg down, two legs down. You notice this leg down is a little longer than this leg down, and now we're starting another leg down, and it's already about equivalent to this leg down. This is a exponential chart also. So we could expect that you're just going to head a bit lower. What you do in between is anybody's guess, because you got a lot of news driving the market back and forth. You had the Bank of England last week announced that they were reinstituting QE bond buying in order to support the UK pension funds, which had all bought these leveraged bond or debt instruments from BlackRock. Okay, so the Bank of England not only is bailing out the hedge funds, the UK pension hedge funds or pension funds, they're also bailing out BlackRock. So, but then we know BlackRock is, they're the insiders because they're also the Fed's errand boy when it comes to implementing the Fed's own bond buying programs or asset purchasing programs. So that's where we are. Tomorrow we've got the CPI. The PPI seems to indicate that inflation is alive and well on a forward basis. If you're looking at producer prices as leading consumer prices, gas prices are back up. You'll like this, Chris. I was in Malibu over the weekend, and gas at the Cross Creek, I think it was a Cross Creek Mobil station, $7.99 a gallon. I had to rub my eyes. I thought it was in London, but it was pretty interesting. So gas prices are rising again. That's going to become become a component in the CPI again. When it came in, they made a big deal out of it. The Biden administration running around telling them, "Oh, you just got $100, bonus because gas prices fell $1, I guess, temporarily, but now they're back up beyond where they were before." And even our local neighborhood Arco station is running at about $6.30 right now. So, it ain't cheap.
Is that just curiously? Is that that's for like super unleaded? And
no,
then
that's the middle one. 90. No, there's 92. I think it's a high octane. The 87 or 89 is the middle one. Yeah, I always pay the median price, so between the three, because that's the one I use. Even though I could probably use the other one, but either way, it's a lot of money. All I have to say is I'm glad I'm rich. That's all I have to say. Because if I was somebody who was living paycheck to paycheck, that is brutal. So in any case, and there are plenty of working class people in my family still that are really feeling the pain. So that's where we are right now. Now, the interesting thing is today, despite the index rally on the NYSE, decliners are 1849, advancers are 1038. So a little less than 2-to-1. On the NASDAQ, you got decliners at 2499. And advancers at 1671, 1670. It's clicking around a little bit, but basically it's a little bit of mostly just an index rally. It's spinning all over the place. I imagine that the theory here is that inflation remains high, the Fed is going to remain on track, and they're going to kill the economy and crash the economy, and then they're going to have to turn and start raising rates. But like I said, market will figure that out first. The wild card here, though, that I think a lot of people overlook is, the Fed may stop raising rates, but if the economy crashes, that in and of itself is going to create a big liquidity vacuum. So it's not clear to me that the economy will instantly recover if the Fed pivots and all the liquidity that's been sucked out of the economy by decline in economic activity is going to magically come back right. So that a little bit of a wild card there, but I think all you have to do is watch the stocks. So we've got some stocks that we've been focusing on the short side, like Celsius Holdings, which, as most of you know, is a punch bowl of death that is now. It was a punch bowl until it broke the 20-day line up in here on the daily chart, and now we're well below the 10-week line and the 50-week line. So at this stage, you're watching for rallies. Well, today we get a rally into the 10-day line and it rolls back a little bit. You're watching for rallies into the 20-day line, maybe as high as the 50-day line as entry points, because now you're slightly extended on the downside. The other one we've been after has been First Solar, and that is this is a very bizarre pattern because it is a very steep punch bowl. You come straight up off the bottom, and you've got this left side peak over here. So if it broke back below that, yeah, you would have a punch bowl of death type of formation, but you don't really need to worry about that because what it's doing right now is already the one thing about a punch bowl of death, and everybody gets hung up on trying to label something, and the main point I would make is that unless you bust the 20-day line, which First Solar has never done, you're still just a punch bowl breakout. Okay, you're never a punch bowl. So people want to try and slap labels on things. And then magically that indicates that, that you just short it, But as we talked about in our second book, labels are just a crutch for people who just don't really have a clue what's going on where the rubber meets the road. So in this case, what's happened here is you had a gap up breakout that failed. Okay, so that's a late stage failed base. And once you bust the 20-day line, it's now in motion. So that rallies back up into the 20-day line or where you're shorting it. So that's basically what's going on now. You had a rally into the 20-day line this morning when the market tried to rally, but that's failed. And now you're heading for the 50-day line. We'll see whether it continues to bounce between the two moving averages, which is typical for a late stage failed base. It'll break the 20, head down to the 50, and then bounce back and forth between the two moving averages for a period of time before it either tries to come out again if the market turns or it just blows up and heads lower. And when you think about this rapid ascent up the right side of this punch bowl formation, there's nowhere where it's really consolidated. So you haven't gone through a process of wringing out weak hands and bringing in strong hands up here. What's happening now is it's coming back the other way. So with that lack of technical support of the stock taking some time to consolidate the gains and in the process push out weak hands and bring in stronger hands, it hasn't gone through that process, and that makes it vulnerable to a very sharp decline. My guess is it would break hard if we see a panic low materialize in the markets. But for now, we haven't seen that happen. It seems like the market's just spinning around, hoping that the Bank of England action, resuming QE, it means that the Fed will soon face a similar crisis. And in fact, I think there are some issues that are being created with the problems that you're seeing in the UK and in Europe as well. Yesterday, the Fed had to send $3.1 billion to the Swiss National Bank, and you got to wonder what that was all about. So in any case, that's basically what we're looking at. In this position, most stocks are not really in shortable positions at this point. I think when you look at some of the solars, some of the stocks we've been looking at over the past couple of weeks, like SunPower is just blowing apart. And notice how it can't even hold support at the 200-day line today. It's just blowing lower. So, and some of the other solars, and all of these rallied on, including First Solar, on the pork barrel spending bill for clean energy that Congress passed. Was it a month or two ago? I forget. But that's what drove this rally. And to me, all that does is set up short sale opportunities, First Solar being one of them. And these others have also broken down. We have Enphase. I know we've talked about that one before. That's also a punch bowl of death. And you finally broke the 20-day line here. And you'll see in this case, you kind of flop around the 50-day line and the 20-day line and also along these lows. So you come down hard here on the initial break. You get an undercut and rally through these lows in here. And then you bump up into the 20-day line. You've done that twice, and now you've broken down through the 50-day line in earnest. And now you're in a position where only rallies into the 10, the 20, or the 50 would be where you would want to try and short it. But for now, it looks like, based on the fact that it is a punch bowl of death with this one big straight up from the midpoint, I'd say, of the pattern here, you probably headed down to 220 support. We'll see how that plays out. But that's how some of these are laying out right now. And I think if you are seeing things rallying, you could theoretically come and try and short this rally, just like yesterday's rally, which was running on news that the Bank of England said they were going to extend their bond buying program. And then around, I guess, 10, 15 minutes before noon, my time, which is a little over an hour before the close, news hit the wire that they informed UK pension funds that they had to rebalance by Friday. So if we look at the SPY, for example, yesterday, you can see when that occurred. And it's what's interesting, if you follow me on Twitter, when the NASDAQ, let's actually use the NQ pound F here. Let's use the NASDAQ futures. When you got this bar right here, you can go back on my Twitter page. I actually said, okay, I was short, then long, and then I blew out all my longs and went short again here, and I tweeted the pattern when it was right there. It bounced up into the 20-period line a couple times and then finally busted. So you could see the market was already getting an inkling of this, and it came apart at the end of the day. So that turned out to be very profitable swing trading day, but that's all this market is. It's basically a swing trading, day trading type of environment. And if you're a trend following long side investor, you're better off just being in cash. So, and that's basically the view. We can run through some of my lists and just see what's going on in general. If we look at, we'll bring up my weapon of choice, which is HCS Investor Software. Let's kind of extend everything out a little bit. So the one thing that I'm watching here closely, let's just say for the sake of argument that the market recognizes that the Fed is on the verge of creating a massive collapse, okay? And maybe there's some sort of financial crisis as well. I think that silver and gold will likely rally. So I keep the miners on my radar. And I basically have 4 favorites. Silver would be First Majestic, and Mag Silver, which is this one also. And you can see all they're doing is chopping around. You could argue that they're in bear flags. And then you have Anglo Gold Ashanti, which is, they have higher operating costs, one of the top 5 gold miners in the world, but highly leveraged to changes in the gold price. So if you saw the price of gold rally, then this would be probably your best play as far as a leveraged situation. Goldfields is another one I like, mainly because they just bought up Yamana Gold, so their gold and silver resources and reserves are huge. So if the metals turn, these will turn, and you'll get more leverage out of these. So I'm just watching them, but there's really nothing substantial yet. I mean, this morning I traded AU and AG for a couple of dimes very quickly, in and out. And you can see with silver, we're just breaking down here. So if you look at silver and gold and you look at Bitcoin, they're all in bear flags, okay? So, I mean, I think what it's all telling you is that we're going to break lower all around. So I'm not necessarily bullish, but I will probe if I think things are turning, okay? So that's basically where I'm at with that. If we look at, say, the big stock NASDAQ names, so if we run through this list, Apple just continues to trend lower. I don't see any bottom in sight yet. Amazon looks very similar. In fact, most of these correlate very closely, at least over the last couple of weeks. Cisco going lower, Google going lower, Alphabet going lower, Intel going lower, Meta Platforms, a joke of a company. It's funny because all the way down, and this extends back for several months, you get all these like geniuses from Kevin O'Reilly to Jim Cramer on CNBC, all telling you that, oh, you got to buy this because it's a value here and here and here. But they don't understand. And it's always amazing to me that all these professionals that go on TV, they don't have a basic understanding of PE expansions and PE contractions and what they are telling you about the future price direction of a stock. When a stock like Meta Platforms, which is essentially, the scandal-ridden Facebook in disguise, is sporting a 20 PE, that's telling you that the market does not place a very high value on their forward earnings stream. So it's telling you that there's an issue. It's not telling you, hey, this is cheap, like buying a shirt at the store, a $50 shirt on sale for $25, buy it. It's not like that, okay? Because a shirt probably has more absolute value than Meta Platforms does right now. But you get a sense of just how brutal this is. And we've had people thinking that Netflix is a great value on the way down. But look at this thing. It's just been crushed. You were up here at a peak of, what was the high here? 691 or something like that up here. And now where are you? You're about 2/3 of the way down. So, it looks like we're getting the turn in. You might have heard some of my dinging over here on my trading platform. But the UVXY looks like it may be trying to turn. It's had a couple of attempts already. Let's go to the real time. Yeah, you're down in here. Yeah, you're in an area where you could try to turn. So you want to watch this. We had some tradable moves earlier in the SQQQ off the lows early in the day here, and you ran up from about 61.50 all the way up to about not quite 64, and now you're back down. But you can see how it's been a very choppy day. The market is it's basically dancing to the loco motion, as I tweeted earlier today. It's just chopping around, but we know what's going on here. It's just an index rally. The majority of stocks are down, and short sale targets are working. You look at First Solar, for example, and SunPower just busting the 200-day line. Also, some of these, real quickly, these lithium names that we were talking about last week, that were up in here, like living along the 50-day line, has completely come apart. Lithium Americas has completely come apart. And we talked about these last week, if you recall. Anyways, where was I here? So we got Microsoft, lower lows. This is not a market turn. It's just whatever they're doing here today. I don't know. They're manufacturing a rally, and I'm not sure what it's predicated on. But we'll see what happens tomorrow after the CPI number. But it should keep things volatile. Tesla making lower lows. And again, another example of these incompetent fools who are somehow giving credence on cable financial TV, like Arc Lady, Kathy Wood. She buys more Tesla here, and then she buys more here, and now it's just going lower. And it's like, okay, what is your position management strategy? Do you have a selling discipline? Apparently not. I guess what she does is just she continuously buys things on the way down. And that's why her funds are blowing up, and they're pretty much a joke at this point. I don't understand why anybody would take her seriously, but apparently people still do. But if you look at this, what you see is essentially I got lucky and rode this big wave, and now it's crashed on me, but I'm still trying to ride it because I don't know what I'm doing. And I don't know what I just went through. A massive PE expansion of all kinds of infinite PE names, of innovation stocks that make no money, of SPACs, of crypto-related names, etc. It's just a big bubble. That's all it was. And that's all she rode, was a big bubble. And now the bubble has burst. And now we're actually approaching the lows of the 2020 pandemic, when the pandemic broke. And there you go. So, in any case, but buying more Tesla on the way down, I don't really understand the thinking here. Maybe one of you could explain it to me. So what else we got going on here? If we look at cloud leaders, okay, what's going on there? Well, these are all blown apart. Over the past week, you got Bill.com, and a lot of these are infinite PE stocks. Coupa Software, a lot of these have been in bear flags, and now they're just breaking the lower lows. So despite the fact, and you'll notice most of these are down today, despite the fact that the indexes are up, but we know why, because breadth is about not quite 2-to-1 negative. Okta, Workday, I can remember this Salesforce is in here. Yeah, Kevin O'Leary, Mr. Wonderful. I think he's Mr. Moron, but that's just me. Over here in the summertime telling everybody that, you had to own CRM at 220 or 200. Now where are we? And again, it's because they don't understand the basic principle of PE expansions and PE contractions. That's why leading stocks, when they start their moves, have huge PEs, and the reason is because the market is placing a very high value on their forward earnings stream, and that's telling you something because the market discounts the future. Let's look at semiconductors. What's happening there? I'll look at the big stock semis. I think I have 19 names here. These are some of the big components on all the ETFs, like the SOXS, the SOXL, etc. AMD just going lower. You see that? And it's getting pretty oversold, but in this case, oversold has just gotten more and more oversold. And just because these look cheap doesn't mean that they are. And the other thing to think about is that the market overall has undergone what I would call a systemic PE expansion for even the most rudimentary, kind of mundane names like railroads. And when Chris and I started in the business, semiconductors, would sell at 6, 7, 8 times earnings, maybe 10, 12 when they were running. Today, semiconductors routinely sell at 30, 40, 50 times earnings. So that's a systemic PE expansion that was created by QE. And now that is becoming unwound. So these things can all go a lot lower. And if you run through these, you can see that they are. KLAC, KLA Tenka runs through this low here, but there's no bottom yet. LRCX, Lam Research, another semiconductor equipment maker going lower. Lumentum Holdings breaking lower. Marvell Technology breaking lower. Microchip breaking lower. Micron is one that's trying to hang in here. They recently reported earnings, and I guess people think that everything is known now. All the bad news is out. I would argue otherwise. A few years ago, I don't know if it was like 3, 4, 5 years ago, but Micron at one time sported a 2 PE. Okay, and it kept going lower. I remember when it was 5 and people tweeting at me that they're buying it because it's a value stock and blah, blah, blah. Well, it went lower, and now here we are at 5 times trailing 12 earnings. Can it go to 3? Sure. 2? Sure. 1? Recently, we saw U.S. Steel was trading at 2 times earnings up here. So you would think, man, I got to be long this stock. It's only 2 times earnings and it looks great. Well, it topped at a 2x trailing PE. But what was that 2x trailing PE telling you? It was telling you that the market placed very little value on the forward earnings stream. So you got all these PEs that have expanded over the last 13 years, 12 years since QE was instituted. And for most people, that is sort of like, reality. In terms of, they think that's normal. So there are a lot of people out there. There's a great quote I saw somebody wrote in an article that there are a lot of investors out there who, if they started investing after 2009, they've never seen what a normal market. And they've never seen a market where the Fed is the single driving force behind everything and the PE expansions that have taken place. So, I wouldn't get carried away with technology. I wouldn't get carried away with innovation or whatever else you can conjure up in terms of a good pitch piece on various stocks or even crypto. What drove all of this higher in 2020, 2021 was nothing more than the most massive inflow of QE since they started instituting QE and money printing back in 2009. So I should say 2008. So that's where we are.
Yeah, also say that in 2000, 2001, 2002, all the technologies, everything, Amazon, eBay, the best things out there got taken down huge. There is nothing left standing in bear markets. We do look for the names that might buck the trend, but 2000 to 2002, I can't think of one tech name. Maybe you get a pocket of it because of some news event like 9/11. But over those 3 years, things were devastated, and we're in a worse situation. I think the bubble today is bigger than the bubble was back then. So there's a lot of unwinding ahead.
Yeah, definitely. I think that's pretty obvious, isn't it? In any case, travel names. There's been a lot said, the reopening and blah, blah, blah. But you can see this area of the market is still just flat on its back. Retail names, okay. These are all flat on their back, and everything's in a bear flag. And you really can't get much of a rally out of things. Wherever you do get a rally, like Amazon's rally was just right into the 200-day line in mid-August, right there with the market, and it's rolled over. That's a retail name. Best Buy, same thing. Canada Goose, just down the line. So everything is busted. You might look at something like Chipotle. Maybe it's a short as it tries to poke its head back above the 200-day line. Crocs might even be a short here along the 200-day line. Deckers, maybe it's a short as it tries to push into these high. I don't know what's driving that higher. But that's, the story of the market right now, and that's pretty much it. And, where are things actionable? I think that the key here is to stick with a few names that you're campaigning. So I like the Celsius Holdings. I like First Solar. I've liked the lithium names. You look at some other stuff. Let's look at, this is a great list. I created this actually in November, and some of you might remember from some of the webinars that we did back then. I went through some of these names, and you look where some of these have come from since November. So here's November, and that's when they all topped. But it was at that point that I could see the market was raising interest rates to a point where you were going to start to see PEs contract. And if they're infinite PEs, they're going to contract quite a bit. And that's exactly what we've seen. If I go through this, let's maybe I can let's pull up a weekly. Yeah, and you can just get a sense of what's happened. I had some guy on my blog page who's commenting to me. He was going into like, I guess he read a book on real estate cycles, and so the real estate cycle wasn't going to top until 2024 or something like that, and therefore he's not looking for a blow up in stocks. And I'm thinking to myself, what a goofball, because if you're paying any attention over the last 10, 11 months, stocks have blown up. Hello? And you're arguing that you're not looking for a blow up in stocks because of some real estate cycles you read about in a book that are irrelevant to today, because we're in a weird period. Never before have we seen the Fed raising rates in a bear market, especially after 11 months of a bear market. Never before have we seen the Fed raising rates into what is now a 2-quarter recession, regardless of what the government wants to try and pitch to us. So the underlying conditions are so bizarre that you cannot rely on old cycles as a predictor. All you can do is look at the charts, and what the charts tell you is that stocks have already blown up. So I think some people just don't really have a clue. I don't know what they miss the forest for the trees. Look at some of these. Blink charging. Okay, this thing go to 5. I don't really see the electric vehicle charging business as being going to be some high margin thing. It's basically infrastructure type stuff, so it's not going to be high margin. Beyond Meat. Where's this one? I mean, this one's just come apart, but it was way up there at one time. And anybody who bought that product knew it was crap, right? I mean, it's garbage. Confluent, ChargePoint. This is another one. It's going back to the lows. That's what I think. Chewy, probably. I mean, these guys actually do a good job at what they do. It's a reasonable online pet food or pet supply type of outfit, but they're not making any money, which surprised me, because how can you not make money selling pet food? Something's wrong. That poor management. So this thing probably ends up testing the lows. We'll see. Coinbase is just death. I mean, it's probably going lower. If Bitcoin goes lower, it's probably going with it. Carvana, CyberArk is potentially, well, it was shortable earlier in the week. You see it busting the 50 or the 10-week and the 20-week. DraftKings going lower. So my point here is that so much of this stuff, oh, here's one that's still sticking. Oh, Iridium. This may be one to keep an eye on as a double top type short. So it's hanging in there, surprising. But there's always one, market's always got one or two party poopers. But for the most part, this is what's going on. And if you sit there and tell me that you're not expecting the market to blow up, well, you're just a clueless moron, and you really can't see the forest for the trees, because the market has blown up. Stocks have blown up. And the thing is, they could continue going lower. It reminds me of January of 2000, and the market's going crazy. We're making tons of money. And Bill O'Neill says to me, this is probably going to end in a climax top. And when it all tops, people are going to be shocked at how low stock prices go. And in fact, they were. They were calling Cisco a buy at $55. Cisco eventually went to $8. And that's where Bill was trying to short it. Too bad. He used to be an indicator on the trading desk. When I got there, I found out they told me that, okay, here's a big secret here, is if we're in a bear market and when Bill starts shorting, that's the bottom. Because he's just a very, positive, optimistic type person. So when he starts getting pessimistic, things have probably gotten so bad that it's a bottom. But you look at some of these space names, Rocket Lab, these guys actually put stuff into space, and they've done many launches. But where's the real value? Where are the earnings? Not there. So that's what we got going on. So that's the market, and I think we're going to go lower. But the path that we take there could be circuitous. Coming down a steep hillside, a lot of switchbacks and stuff, and that's basically it. So some questions. Somebody says, trying to campaign Vertex short at 10 DMA, watching 20 DMA. Potential 2-year pod. Yeah, that is. I don't know. Is it a pod, though? Let's look at that. I don't know if I would call this a pod, a punch bowl, because it's too long. Okay. The characteristic of a pod or a punch bowl formation is you have a very rapid decline, usually less than, say, 28 weeks, 30 weeks, and then a very rapid ascent, about the same maximum number of weeks. Okay, so it's not it's not really a pod because you have this long area of consolidation going on since April. So I wouldn't call it a pod, but it could be a late stage failed base. It's got a couple of other dynamics going on here that I think make it a candidate on the short side. So I think you're right on that basis. I just don't think you can necessarily label it a pod. In fact, you can't really because it's not. It doesn't really fit the definition. But let's go to my intraday. There we go. So what's going on here is that you've been running into the 300 level. You got a little double top here over the last week, and now you're hovering at the 20-day line. If it busts that, then all bets are off. You short it there, and it's probably heading lower from there, and that would probably coincide with the market break lower. So basically, that's what I think about that. But yeah, you're on the right track there as far as going after that as a short sale target. So this is amazing. Still got the Dow up 154. Let's see, breadth is still, let me check my numbers here. You still got, it's starting to pick up a little bit. 1148 up on the NYC versus 1755 down. 1786 to 2442 on the NASDAQ. So we'll see how this all plays out. But I would say overall, this is a pretty crazy day. So, but anyways, that's all I've got. Any questions? Any last questions before we wrap it up? None? Okay. Well, anyways, that's it for now. We'll see where this goes. You got the CPI tomorrow. That's sure to roil things, and we'll just see how that plays out. So, have a great week. We'll talk to you next week. Take care.
So long, everyone.